Hello and welcome once again to the Junior Achievement Stock Market Challenge. I'm your host, Mark Wyand, and today in session 3, we're going to be talking about the fundamentals of the stock market. Some general goals and objectives, not only of this third session, but the first two as well. Again, we want to really deepen your understanding of how stocks operate and how the stock market works. We want to prepare you for the JA Stock Market Challenge, which is coming up on March 1st. And finally, we want to establish a foundation and become a smarter, more informed investor going forward in life beyond this particular JA activity. And why does this matter? Well, again, as I stated in the first session, the stock market's going to play an integral role in business and in the economy around us, whether we're directly involved in the stock market or indirectly. It's important to save and invest money for future goals. And finally, you're going to be exposed to the stock market in multiple ways, whether you have a 401k with a company you work for, a pension plan, if you participate in a college savings plan for your children, if you hold insurance policies, health savings accounts, etc. In session 3, we will be covering the following topics. Number 1, understanding the mechanics of how stocks trade. 2, defining what stock exchanges are and their importance to making the stock market function efficiently. Number 3, defining the role of the stockbroker and how brokers help investors complete trades. Number 4, we will also cover how to read stock tables and interpret some of the information that can be gleaned from them. And finally, number 5, we will provide an introduction to stock market indexes and how they are used to track the stock market. We're going to be covering a lot of technical information today, so let's dive right in. A stock is exchanged when one investor sells their shares of stock and another investor is interested in buying those same shares. However, especially in today's world, buyers and sellers almost never actually meet. So how are they brought together, and how is this trade actually executed? How do buyers and sellers find one another in order to exchange those shares? The answer is this: buying and selling is done through stock exchanges. So what exactly is a stock exchange? When a company completes an IPO, an initial public offering, as we covered in the second session, its shares become owned by the investing public, and from that point forward, those shares are traded on the stock exchange. A stock exchange is a location in which stocks are bought and sold, and stock prices are decided. So similar to the way Wegmans brings groceries from farmers and other suppliers to customers so they can shop for the food they eat, or the way Amazon.com provides an online marketplace for millions of sellers and online shoppers, stock exchanges create a market for investors to buy and sell shares of stock. It's important to reiterate that stock exchanges enable existing owners of shares to trade with potential buyers. So when an investor buys a share of stock through a stock exchange, they're not buying it from the company who went public via the IPO. Investors are buying it from another existing investors or shareholders. Likewise, when you sell your shares, you do not sell them back to the company, rather you sell them to another investor. This interaction with other buyers and sellers is called a secondary market. The first stock markets appeared in Europe in the 16th and 17th centuries. The first stock exchange in America was the Philadelphia Stock Exchange, which still exists today. The most famous stock exchange in America is probably the New York Stock Exchange, or the NYSE, which was founded in 1792 under the Buttonwood Agreement. Before the Buttonwood Agreement, that led to the formation of the New York Stock Exchange in an effort to better organize stock trading, traders would actually meet unofficially under a buttonwood tree on Wall Street to buy and sell shares. Today, there are many stock exchanges in the U.S. and throughout the world, some of which are listed at the bottom of the slide. So what exactly goes on at a stock exchange? When most people think of a stock exchange, the trading floor of the New York Stock Exchange is the image that comes to mind. It's often the image that's plastered on TVs or in newspapers on particularly volatile trading days that make headlines. The photos in this slide show the New York Stock Exchange various times throughout history. The photo on the upper left is from the 1930s. The photo on the upper right is from 2007. And the photo on the lower right is the most recent snapshot of the trading floor. The photo on the lower left shows a couple of guys standing on the floor in jackets and ties, reviewing information on their tablet computers and iPads. So what stands out as differences or similarities in these photos? I think what's most obvious is that over time you see there are less and less people on the trading floor and more technology. Let's discuss these observations by exploring more in depth what takes place on the exchange. A couple of slides ago, we defined a stock exchange as a location in which stocks are bought and sold and stock prices are decided. However, we use the word location in quotation marks. Why is that? The reason we use quotation marks is that stock exchanges are increasingly being disrupted by technology, much like other industries in our economy today. Back in the 30s and as late as the 90s, most trades on stock exchanges were carried out on a trading floor by hundreds of traders, brokers, specialists, and market makers. Traders and brokers can be thought of as middlemen or go-betweens for the buyers and sellers of stocks. They essentially buy and sell stocks on behalf of other investors. Specialists and market makers work for the stock exchanges, specialist companies, or for themselves, and their job is to help match buyers and sellers and provide additional liquidity to the market using their own inventory of shares. In other words, if a buyer or seller is not readily apparent, specialists and market makers step in and fill the void. This network of people would receive calls and orders from other brokers all over the country and all over the world, and they would work together face to face to execute trades and set prices. Let's walk through an example to see the way it would typically work. First, an investor would call their broker and direct them to buy 100 shares of stock X. Next, the broker would place the order on behalf of the investor, and the broker's order department would send the order to the trading floor broker or clerk at the stock exchange. Third, the floor broker or clerk alerts one of the floor traders who finds another floor trader representing another investor willing to sell 100 shares. If no floor trader could be found, specialists and market makers would step in. Once a match was found, the two sides, traders, would agree on price and complete the deal. Afterwards, the notification process would go back the other way, with the original broker eventually calling the investor back with the trade details. Today, most stock markets use vast computer networks to match buyers and sellers instead of human traders or specialists. In fact, the New York Stock Exchange is rather unique in that it still has a trading floor with brokers, traders, specialists, and market makers. For example, the NASDAQ Stock Exchange does not have a trading floor at all, and all of the trades that occur are through electronic means. Importantly, most stock trades today are made and recorded electronically. Even trades that still occur down on the floor of the New York Stock Exchange take place with little to no face-to-face interaction and typically involve only computers and iPads. Your trading environment for the JA Stock Market Challenge event on March 1st will make use of technology to execute trades, but will feel like a traditional stock exchange floor from years ago. Teams will be communicating with floor traders directly when they buy and sell shares of any stocks. So how are stock prices set on any given exchange? Recall that from the last webinar, stock prices move up or down based on supply, selling, and demand, buying, for the stock. But how is the actual price established and agreed upon? The most common way stock prices are set on a stock exchange is through an auction process. Have you ever been part of an auction? Most of you, I'm guessing, might think that you've never been part of an auction. But the definition of an auction is a public sale in which goods or property are sold to the highest bidder. In fact, anytime someone goes shopping online for an item, they are technically participating in an auction. For example, if I wanted to shop for a football online, I type football in Google, and the website says several retailers with footballs for sale will show up in my search results. Each of the sellers or websites are asking for a certain price in exchange for the football. Customers, or the buyers, need to determine if the football is worth the price being asked. In this example, the ask price, the price from the retailer, is public, but the bid price, the price customers or I am willing to pay for the football, is secret. For example, the retailers don't know how much I am willing to pay for my football in particular. When it comes to the stock market, buyers and sellers each have prices in mind, but the main difference between the football example and stock exchanges is that both the bid and the ask prices are public. Buyers of stocks provide public bids and sellers of stocks provide public offers or asks. Thus, each stock actually has two prices at any given time during the trading day, driven by all the public bids and all the public asks being provided. A market's bid price on a stock is the highest current price an investor is willing to buy the shares at. The market's ask price on a stock is the lowest current price an investor is willing to sell the shares at. I'm going to say that one more time because that's very important to understand. A market's bid price on a stock is the highest current price an investor is willing to buy the shares at. The market's ask price on a stock is the lowest current price an investor is willing to sell the share at. This can also be stated another way. The market's bid price is the highest price an investor can sell their shares at. Very simplistically, if no one in the market is willing to buy shares at the price you're asking, you will need to drop the price. Similarly, the market's ask price is the lowest price an investor can buy shares at. Simplistically, if no one is willing to sell the shares at the price you are bidding, you will need to raise the price at which you're willing to buy. This interaction goes through the exchange among all investors at once. If there are more buyers than sellers of a given stock, bid and ask prices move up. And if there are more sellers than buyers of the stock, bid and ask prices move down. Any difference between the bid and the ask price of a stock is typically called the spread. But when the bid and ask prices between two investors match up, a trade is completed. So in summary, stock exchanges are critical for any well-functioning stock market. Stock exchanges provide a single location to buy and sell stocks. They match buyers and sellers efficiently, and they require buy and sell prices to be made public and transparent. All these attributes enable millions of trades to be completed every day around the world. Even though stock exchanges are increasingly computerized and technology is changing the way they work, it is important to realize that stock exchanges retain their importance in making the stock market work efficiently. In fact, one of the main advantages of technology and electronic stock exchanges is that markets have gotten faster and even more efficient over time. Technology has made it easier and quicker to match buyers and sellers, share pricing information, and complete trades. The bottom line for all stock exchanges is that they must ensure that trades will go through at fair prices and within a reasonable period of time. If they don't, investor confidence will be undermined, and companies will no longer list their shares on any stock exchange that violates this expectation. The priority for stock exchanges is to provide protection to all investors through rules that promote ethics and equality. Understanding stock exchanges and how they work is only half the story in understanding how stock trades are executed. The other critical piece that needs to be understood is the role of the stockbroker. Brokers are people, firms, or increasingly online platforms that place orders to buy and sell shares on behalf of investors in exchange for a small fee called a commission. A broker essentially acts as a middleman for the buyer and the seller because investors are not able to access the stock exchange trading floors or electronic networks directly. Hence, every investor still needs a broker to handle the trades they want to make. Brokers access the stock exchange network, and the system finds a buyer and seller depending on the order placed. Historically, brokers were hired by wealthy individuals and families, but today a wide range of stockbrokers exists for all price ranges. This is being driven by the internet and the rising popularity of online brokers that can facilitate trades at lower commissions. Similar to what has occurred on stock exchanges, placing orders electronically is cheaper and more efficient than placing them through people. Many online brokers will charge only $5 or so for a trade. And there are even apps now that claim to place trades for free. Both full-service brokers that offer physical locations and access to investment professionals, for example, Edward Jones and Merrill Lynch, and online brokerage platforms such as Charles Schwab, E-Trade, they'll compete with each other and differentiate themselves on price, what they charge for commissions when placing trades, breadth of services such as research and opinions on stocks, the economy, financial planning advice, and the ability to establish a personal relationship, and technology, online tools and information. The graphic on this slide does a nice job of showing the options a stockbroker has after an investor places an order to buy or sell shares of stock. The broker will communicate the investor's intentions to a centralized order room, typically called a trading desk. The broker's trading desk then has a number of options. It can, 1, communicate the order directly with the floor brokers on the stock exchange. 2, communicate the order directly to firms that are market makers or specialists in the particular stock. 3, place the order through the stock exchange electronic network so it can be seen by other market participants. Or 4, complete the trade for the investor utilizing any inventory the brokerage firm itself might happen to have. In other words, the brokerage firm itself acts as a market maker. So now that you have a better understanding of how trades are executed, let's discuss the process for investors to make a trade. Regardless of the type of brokerage used, the mechanics of buying and selling shares are pretty uniform for the investor. The first step is to obtain a stock quote from the broker. A stock quote is price information on a given stock and typically includes the current bid and ask prices, as well as the last price at which a trade occurred. Stocks are typically quoted by their ticker symbol, which is typically a 1 to 4 letter representation of the company's name. So for example, Microsoft is MSFT, Apple is AAPL, and Caterpillar is CAT. Incidentally, in the early days of stock exchanges, price information was transmitted via ticker tape, which was a long ribbon of paper that printed price data via telegraph wire. That's why stock quotes are often referred to as the ticker. The second step for investors to place a trade is to determine the type of order to be placed. There are 3 main types of orders that an investor can place with their brokers for both buys and sells. Number 1 is a market order. A market order instructs the broker or online trading platform to buy or sell shares at the last available price, at market. A market order does not guarantee the price you will get, but it does guarantee that you will get the number of shares you want bought or sold. Market orders are used most often when the buyer or seller is primarily concerned with completing the order and is not as concerned about the actual price they get. The second order type is a limit order. A limit order specifies to the broker the price at which the investor wants to do the trade. Limit orders are used by investors who are primarily concerned with the price they want to receive, but they are not guaranteed that their buy or sell order will be completed. For example, a limit order on the buy side is only completed if the broker can buy enough shares at or below the price specified by the investor. If the stock price is above the specified price, the broker does not buy the stock for the investor. So just as a quick example, let's say I want to buy a stock that's currently trading at 105. I'm really interested in this particular stock, but I don't like the price it's at. If I want to say value this company at $100 a share, not 105, I might put it in a limit order to buy at $100. Now, once that order is placed, the price may or may not go down from 105 to 100. If it never does, I'm never going to be able to purchase those shares. But let's say the price does come down from 105 to 100 or even lower, then once that number is triggered, my order will go through, will be completed, and I'll buy those shares at 100. A stop order is the third and final order. This is a type of order in which the broker only executes a trade if the stock an investor wants to buy or sell reaches a particular price. However, unlike a limit order, if and when the stock reaches the specified price to activate the trade, a stop order essentially becomes a market order, and the remaining shares are bought or sold at the prevailing market price until the order is completed. Thus, stop orders are not guaranteed to be completed at the actual price the investor specifies. The price may drift higher or lower than the activation price as the trade is being completed. So again, let's change up that example. I own a current company, and let's say again it's trading at 105. Maybe I don't want to sit on this stock if it continues to lose money. So maybe I set a stop sell order at 100. Again, the price of the shares 105. I set my stop at 100, so $5 lower, in order to sort of prevent significant losses below that. And let's say this particular stock or the market as a whole is dropping, and the price does indeed drop to 100, but it falls even further from there. Well, once that price is hit, that $100 stop order, my broker knows that I want to liquidate my shares. So if the shares continue tumbling and the prevailing price goes from 100 to 99, 98, depending on the number of shares I have, other buys and sells in the markets, I might get stopped out. My shares might be sold, but some shares might be sold at 100 and some shares might be sold at 99, 98.50. So it guarantees I get out once that stop number is triggered, but it does not guarantee the price at which I'm going to be able to get out of all of my shares. Once a stock quote is obtained and the type of order is determined, the last step is for the investor to instruct the broker to execute the order. For the JA Stock Market Challenge, all buy and sell orders placed by competing teams will be market orders. And instead of going through brokers to place buy and sell trades, teams will interact with floor traders directly. So one more time. The day of the challenge, all your buys and sells will be market orders. And instead of going through brokers to place any of these buys or sells, your team will be interacting with the floor traders themselves. Now let's take a look at a stock table. The one we have up on the screen is for Apple, ticker symbol AAPL. One of the ways that investors find information about a company is to read these stock tables. Stock tables contain some of the information that investors use to track individual stocks and help inform decisions about buying and selling stocks. Stock tables can be found in many places, including on financial news and analysis websites and apps, Yahoo Finance, Google Finance, Bloomberg, etc. In a newspaper like the Wall Street Journal, and on online brokerage platforms like Charles Schwab, E-Trade, TD Ameritrade. The following types of information can be found on most stock tables: the company's name and ticker symbol, 52-week range. These are the highest and lowest prices at which a stock has traded over the previous 1 year. Previous close, that's the closing price on the previous trading day. Open, the opening price of the current day. Bid ask, the market's current bid price and the market's current ask price. In this case, these are the bid and ask prices that existed after the market closed at 5:12 p.m. Eastern Time. Days range, this indicates the price range at which the stock traded throughout the day. Max and min prices that investors paid for the stock on that day. Volume, this figure shows the total number of shares traded on a particular day. Average volume, this typically represents the average daily traded volume over the last 3 months. Market capitalization, or market cap, This represents the current price times the number of shares outstanding, outstanding meaning owned by all investors. It tells you what the company's equity is worth. Beta is a measure of volatility of the stock price relative to the market as a whole. We will discuss the concept of volatility a little bit more in session 4 when we discuss the risks of investing in stocks. PE ratio. The price to earnings ratio, PE ratio, divides a company's current stock price by its net earnings per share from the last 4 quarters. PE ratios are used by many investors to judge whether a stock is cheap or expensive. EPS. The EPS figure represents how much of the company's net income or profits is accounted in a single share. So the EPS stands for earnings per share. For example, if a company's net income is 10 million and there are 5 million shares outstanding, EPS would be $2 per share. Earnings date. This is the date the company will next be reporting its financial results to its shareholders and to the public. Forward dividend and yield. The forward dividend figure is the annualized dividend per share the company's board of directors is expected to declare and pay to shareholders over the next 4 quarters. Dividend yields tell you what percentage of the stock's price the company is expected to return to shareholders in cash dividends. It can be interpreted as an investor's expected return in the stock just from cash dividends when buying the stock at the current price. So remember last session we talked about making a financial gain owning shares. You can earn it through cash dividends and also share appreciation. Ex-dividend date. This tells the investor the date at which they need to own the shares of the company in order to receive the next scheduled dividend payment. Based on the information in front of you on this screen, some questions for you to consider. Is Apple's stock near its 52-week high or 52-week low? It's trading near its 52-week low. What parts of the stock table would tell an investor about their opportunity to earn dividend income by purchasing Apple stock? Again, we would want to look at the forward yield, or the forward dividend rather, and the yield. What piece of information tells an investor how much Apple is worth as a company? Again, that would be the market cap. At the JA Stock Market Challenge, the trading floor will have large video screens showing stock tickers, stock charts, and stock tables to help students understand and keep track of their stocks. So let's broaden this conversation from talking about individual companies to talking about the stock market as a whole. In addition to individual stocks, many investors are concerned with stock indices or indexes. This is for many number of reasons. First of all, when you talk about the market in general, that can be a good proxy for the health of the economy. Also, there's plenty of investors that aren't as concerned with individual companies as they are with the market as a whole. An example of this would be, as I had mentioned in the first slide, a lot of us are affected by the market directly, indirectly, because we invest in our own future, retirement, other goals. So for example, in our 401ks, our retirement plans, we might have a fund that invests in the US market as a whole. So we might care about what the market is doing, but not care to the level that we want to know how individual corporations are performing. Stock indexes are a group of companies whose collective stock performance represents the market trend and is followed by investors to gauge the movement of the stock market. More specifically, stock indices represent aggregated prices of a number of different stocks, and the movement of an index is the net effect of the movements of each underlying component or company. Indices can be broad and include stocks from different industries within a country or across many countries, or they can be more narrow. For example, specific to a certain industry or market sector. So maybe there's an index or an index that tracks all of the technology companies. Some well-known broad stock indexes are the Standard & Poor's 500, the S&P 500 for short, the Dow Jones Industrial Average, the Nikkei 225 index, which is the Japanese blue chip stock index, and the DAX, which is the German flagship stock index. Virtually every media outlet reports on the performance of stocks by referring to stock indices. When people talk about the stock market, they often are actually referring to one of the major stock indices. So you might hear someone say, oh, the market was down huge today, 300 points. And that would be the Dow Jones, generally speaking, because that is one of the most widely tracked indices for U.S. large cap companies. Stock indices can be used to measure the performance of overall market and help investors determine if there's a bull market or a bear market. So let's discuss each one of those. A bull market is a generalized term used when stocks are in a rising trend for an extended period of time. Bull markets are usually accompanied by a strong economy when people are finding jobs and unemployment is low and company profits are strong. Picking stocks during a bull market is arguably easier because in aggregate, stocks are going up. If an investor is optimistic and believes stocks are going to go up, he or she is called a bull and is said to have a bullish outlook. However, extended bull markets can lead to investors becoming overly optimistic in their outlooks, which in turn can cause stock prices to become overvalued or price in expectations that are too high. If those expectations are not met, then stock prices can fall, and sometimes dramatically. In contrast, a bear market is formally defined as a 20% decline in broad stock market indices. Bear markets usually happen when investors become worried about the economy. Bear markets are typically accompanied by slowing growth or recessions, a recession being a period of time when the economy stops growing and actually contracts. Rising unemployment and falling corporate profits. Bear markets are usually associated with an increase in stock price volatility, so greater movements up and down, since investors typically fear losses on their investments and become more emotional. So as folks become more emotional with the stocks they own or the indices they own, you tend to see wider swings in the prices they're willing to sell at. Investors do not always act rationally when they become emotional, and there's often overreaction or panic, which can send stock prices too low. Bear markets make it tough for investors to pick stocks that are going to go up, right? So if an index as a whole is dropping dramatically, well, a lot of times even healthy, stronger companies will see really poor stock performance, maybe even undeservedly. However, when there's a panic and there's fear in the markets, this also creates a lot of opportunity for long-term investors. Bear markets can allow for investors to buy stocks on sale or at cheaper prices. Finally, let's do a real quick recap of today's webinar. There were really four main takeaways from this session. Number one, stock exchanges are important for stocks to trade efficiently. All right, they provide one location to trade the stock. They match together buyers and sellers quickly, and they facilitate price transparency. Number two, stock exchanges are increasingly becoming virtual and computerized. Number three, investors need a licensed broker to trade stocks. For the average individual investor, the role of the broker is increasingly being filled by online brokerage platforms. And number four, indices are used by many investors to measure stock market performance. Again, there are plenty of participants that are not as concerned with individual companies as they are with the broader performance of the market or the index. And tracking the index, we see over time there are periods which we would define as bull markets, up markets, and bear markets, which are down markets. And these swings are generally when some of the greatest opportunities and risks are created. So thank you once again for participating in today's session. And I'd like to wish you all the best of luck on the upcoming stock market challenge.